What if I told you that the most powerful force in the finance universe is invisible? It's not a hidden gem, crypto. It's not a secret algorithm. It's not even beating the markets. In fact, it's something so quiet, so small, and so profoundly boring that most people ignore it until it's too late. Welcome to TradingBits X. This channel is all about decoding the economy from the ground up. No noise, just sing. Charlie Munger called it the Lollapalooza effects. Albert Einstein supposedly called it the eighth wonder of the world. Today we're peeling back the curtain of compound growth. We're going to explore why your brain is literally hardwired to misunderstanding and how you can weaponize that misunderstanding to build a level of wealth that seems impossible to the average person. The geometry of wealth. Most of us think linearly. If you walk 30 steps, you're gone 30 meters. That's how we're taught to perceive progress. But wealth doesn't move in straight lanes. Wealth is exponential. Let's look at the classic penny versus $1 million riddle. If I offer you $1 million today on a single penny that doubles every 30 days, which one will you take? If you take the $1 million, you feel rich on day 1. On day 20, the person with the penny only have 5,000. You feel like a genius. They look like a failure. But on day 28, that penny is worth $1.3 million. On day 30, it's $5.3 million. On day 31, over $10 million. Think about that. The biggest jump happened in the last 24 hours. If you had to start your investing journey over today, what is the one thing you would change? Let me know in the comments below. The magic isn't it in the penny, the magic is in the doubling. Compound growth is simple, the result of earnings return on your return. It's a snowball rolling down a mountain. At the top is a pebble, at the bottom is an avalanche. The 4 drivers, the engine. Compound isn't magic, it's a formula, and that formula has 4 distinct levels you can pull. The rate of return, the slope. A lot of people think the difference between a 7% return and a 10% return is just 3%. They're wrong. Over 30 years, $10,000 at 7% becomes $76,000. At 10%, it becomes $174,000. That tiny 3% different result is $100,000 more wealth. That's why we're so obsessed over fees and assets, location, time, the multiplier. Time is the only variable you cannot buy back. Did you know that Warren Buffett made 99% of his wealth after his 50th birthday? He didn't suddenly become a better investor at 50. He just let the tail end of the exponential curve kick in. The cost of waiting is higher than the cost of being wrong. If you wait 10 years to start, you don't just lose 10 years of growth. You lose the most explosive part of the curve, reinvesting. Compounds requires a closed loop. Every time you take a dividend out to buy a new pair of shoes or a watch, you're interrupting the process. You're cutting the snowball in half. To compound, you must be a reinvestment machine. Consistency, the fuel. You don't need to be a hero. You don't need to find an X altcoin once a year. You need to be a veritable, successful for all unusual long periods of time. Be honest with yourself. Are you looking for a home run play, or are you just consistently hitting single every month? Type consistency in the comments if you're committed to the long game. The psychological trap. If compound is so simple, why isn't everyone a villain? Because humans are biological, wired to hate it. Evolution taught us to look for immediately result. If we hunt, we wanted to eat now. Compounds require the opposite. It requires you to work hard, save money, and see zero result for years. The first 10 years of compound feel like watching paint dry. It's the plateau of latent potential. This is where 90% of investors quit. They think, I've been saving for 3 years and I only have $5,000. This isn't working. So they switch strategies. They buy the next big thing. They break the chain. In the markets, the boring path is the only one that actually leads to the destination. patience as an asset. In 2026, patience is a rare commodity. Everything is instant. Instant news, instant food, instant gratification. But because patience is rare, it has become a competitive advantage. The most successful investors aren't the ones with the highest IQ. They are the ones with the highest emotional control. They have the temperament of time. They understand that wealth isn't built in a trading act. It's built in the waiting. As Charlie Morgan famously said, the big money is not in the buying and the selling. It is in the waiting. Let's be real for a second. Most people watching this will agree with everything I had to say. They like the video and then they'll go back to checking their portfolios every 5 minutes looking for a shortcut. Don't be the most people. Start today, not tomorrow. Automate your reinvestment. Take the human element out of it. Forget the exits. Focus on the process. Compound growth is the quiet force. It doesn't scream, it doesn't make headline. It just works, it just let it. Now here's the catch. Compounds only work if you're holding the right assets. If you compound 10% of zero, you still have zero. If you compound a dying asset, you're just accelerating the trip to the bottom. So how do you know which assets are actually worth holding for the next 30 years? Why do some assets like Bitcoin or prime real estate explode in value, while others like cash or fat stock simply go away? In our next video, we'll go dive deep into the logic of value. We'll break down cash flow, scarcity, utility, and narrative. If you want to know what actually buy to let compound do its work, you cannot miss the next one. Click here to subscribe and hit that like button, and we'll see you on the next one. And remember, money, markets, we're trading the future. See you in the next one.